If you are here, you have probably watched our first video where we described how we became self-made millionaires in less than 6 years with only $10,000 in savings. In this short video, we will describe how to determine how much you will need to reach financial freedom for your situation. Before we embarked on our journey of financial freedom and passive income, we sat down and calculated using our bank statements how much exactly we would need per year to survive based on our current lifestyle. And we visualized having 2 children at that time and had a budget for that too. We then worked backwards from that number to try and figure out how many properties we would need, and the amount of rental income that would be generated that would cover our expenses, leaving some room to take a holiday every year and have some entertainment budget. Here is an example of what that looks like. Let's say we need $100,000 to survive per year, including your travel budget. We divide $100,000 by 50 weeks, which means we would need to earn $2,000 per week in investment income. If you buy a unit for say $500,000 and are able to get $550 a week, this means you would need 4 fully paid apartments or houses, giving you a rental income of a minimum $550 a week, to get a net passive income of $100,000. When we started our investment journey, we both worked in full-time jobs. We sacrificed a lot to save for deposits and stamp duty costs to buy our investments. Over the 6 years, despite having accumulated close to slightly over 10 properties, we still found that our portfolio was close to neutral and negatively geared. This means our return of investment was just between 3 to 5%. We had 3 units in one, but even that one wasn't enough to cover the negative gearing of the other properties. We had only those 3 units that generated a positive cash flow of $20,000, and it covered all the negatively geared properties. Surely there had to be a better way to achieve this. Despite doing all the renovations, cosmetic and structural, mining towns, subdivisions and developments, the extra rental income created was still not enough to cover the negative cash flows of our portfolio. We had to think outside the box, and so we took calculated risks and decided to see if we could find a strategy that could help create the passive cash flows that would help to start paying down our mortgage debts.